In the world of investment analysis, the tension between structure and spontaneity, between quantifiable fundamentals and market sentiment, defines the art of forecasting. One tool that has captivated traders and technical analysts alike is the Fibonacci retracement, a set of horizontal lines derived from a centuries-old numerical sequence believed by many to reflect natural patterns of human behavior. Though rooted in 13th century mathematics, Fibonacci retracement persists as a powerful, if controversial, analytical overlay in modern financial markets. For investment analysts seeking to understand price action beyond quarterly earnings and DCF models, Fibonacci retracement offers a behavioral framework, a lens through which market psychology can be visualized and anticipated. At the foundation of this technique lies the Fibonacci sequence, a series of numbers where each term is the sum of the two preceding ones. This sequence was introduced to Western mathematics by Leonardo of Pisa, better known as Fibonacci, in the early 13th century. Though it began as a way to model rabbit population growth, the sequence has since found echoes in nature, art, architecture, and some argue in financial markets. The key insight is that the ratio between adjacent numbers begins to settle around 0.618, the so-called golden ratio, as the sequence progresses. For example, 34 divided by 55 approximates to 0.618, as does 55 divided by 89 approximates to 0.618. This ratio is considered aesthetically and structurally significant in nature, evident in everything from spiral galaxies to nautilus shells, and is believed by technical analysts to represent natural points of equilibrium and reversal. From these numerical properties, several retracement levels commonly used in technical analysis are derived. The most important of the Fibonacci retracement levels is 61.8%, which is the inverse of the golden ratio. Mathematically, this is derived by dividing 1 by 1.618, the golden ratio itself, yielding approximately 0.618. This level is often viewed as the most powerful and psychologically significant, commonly acting as a key point of support or resistance in a market correction. The 38.2% retracement is calculated by taking the ratio of a number in the Fibonacci sequence to the number 2 places ahead. For example, 34 divided by 89 gives approximately 0.382. This level is seen as an early stage retracement that suggests a modest pullback within a strong trend. The 23.6% level, a shallower retracement, is found by dividing a number by the number 3 places ahead in the sequence, such as 21 divided by 89, resulting in approximately 0.236. This level typically marks the mildest corrective movement and may signal that the prevailing trend remains strongly intact. Though not technically part of the Fibonacci sequence, the 50% retracement level is widely respected by traders and analysts. It reflects a common observation in market behavior that prices often retrace about half of a prior move before continuing in the original direction. Its popularity stems more from empirical pattern recognition than from mathematical origin. Finally, the 78.6% retracement level is derived by taking the square root of 0.618, which results in approximately 0.786. This deeper retracement zone is often considered the final potential support or resistance level before a full reversal of the trend is likely. When price approaches this area, traders often view it as a critical inflection point, either for a last chance bounce or a complete breakdown. Together, these levels form a scaffold for anticipating potential market turning points, reflecting not only mathematical proportion, but also the recurring psychological rhythms of crowd behavior. The method is disarmingly simple. Analysts plot the Fibonacci psi tool over a recent significant price move from a swing low to a swing high in an uptrend or vice versa in a downtrend. The tool then draws horizontal lines at each retracement level, creating a visual roadmap of potential support and resistance zones. Unlike trend lines or moving averages, which evolve dynamically, Fibonacci levels are static, anchored in investor memory. Their influence stems not from moving data, but from collective observation. Because many market participants watch these levels, they often become self-fulfilling prophecies. While subjective in placement, consistency in methodology allows experienced analysts to spot patterns across different securities, timeframes, and market environments. Fibonacci retracements serve as scaffolding for deeper market structure analysis, especially when layered with volume profiles or momentum indicators. Why do retracement levels matter? Because markets are not just reflections of intrinsic value, they are aggregates of human behavior. Behavioral finance, as developed by Kahneman, Tversky, and others, has shown that investors are prone to loss aversion, anchoring, and herding, all of which reinforce the idea that certain price levels feel safe or pivotal. For instance, the 61.8% retracement level is often treated with reverence. A pullback to this level feels like a deep but not disastrous correction, offering a perceived buying opportunity in an uptrend. When multiple market participants act on this belief, the level gains psychological gravity, influencing price action in a reflexive loop. In this sense, Fibonacci retracements act as visual proxies for sentiment, allowing analysts to structure subjective intuition into repeatable observation. In the video clip we have on screen, we can see a Fibonacci retracement being drawn on Apple Inc. after a pronounced upward price swing. As the stock begins to pull back, analysts observe its behavior at the 38.2%, 50%, and especially the 61.8% retracement levels. The 61.8% zone acts as a pivot. Buyers step in, volume increases, and price begins to stabilize. This kind of price action reflects the fractal nature of markets, where human responses to gains and losses manifest in pattern behavior. For a portfolio manager weighing a post-earnings entry into Apple, this retracement provides a structural signal to weigh against fundamental drivers, macro conditions, and broader positioning. For the modern investment analyst, Fibonacci retracement is not a standalone strategy, but a contextual overlay. Here's how it can be deployed effectively. Entry and exit timing. After a large upward movement, analysts can identify pullback levels that may offer lower risk entries, or conversely, places to take profit in anticipation of resistance. Catalyst framing. Around events like earnings or regulatory announcements, retracement levels help frame the potential pullback zones if sentiment sours, guiding scenario planning. Risk management stops can be set just beyond key levels, providing a logic-based structure for capital preservation. Confluence analysis. When a Fibonacci level aligns with a prior breakout zone, moving average, or volume cluster, the likelihood of price reacting at that point increases, allowing for multi-signal confirmation. Not all analysts are convinced, so critics argue that Fibonacci retracements are curve-fitting tools, attractive in hindsight but statistically unconvincing. A 2002 study by Carol Osler found little empirical support for Fibonacci levels outperforming random levels in forecasting turning points. Furthermore, the efficient market hypothesis argues that all known information is already priced in, rendering such patterns meaningless. Quantitative strategists may disregard Fibonacci retracements for their subjectivity and lack of robust backtesting data. In truth, the effectiveness of Fibonacci lies less in precision and more in discipline, offering a structure within which decisions can be made and tested. Rather than treating Fibonacci as gospel or garbage, the best analysts treat it as a tactical overlay, a way to align sentiment with valuation. For instance, if a stock is fundamentally undervalued and pulling back to a 50% retracement after earnings, an analyst might increase exposure in shows seeing both technical confluence and valuation support. If a stock is retracing 38.2% but remains overvalued on DCF or ROIC spreads, it may signal a short-term bounce within a longer-term fade. The richest insights come from triangulating signals: sentiment via Fibonacci, fundamentals via valuation, and macro via thematic drivers. Fibonacci retracement is not a magic wand. It is a map, a visual representation of where fear and greed may pause or pivot. For the investment analyst, it is a way to capture behavioral probability, not deterministic certainty. Used wisely, it fosters structured thinking, improves entry-exit discipline, and enhances communication with traders, PMs, and clients alike. And in a world where value is only part of the equation, understanding the patterns that shape price can give analysts an edge, not by predicting the future, but by preparing for its most probable paths.